regards to the pension fund cap of 1.6 million and the partial commutation concept, is it correct that you cannot use partial commutation as an offset in taking the minimum pension from that account?
No, you can't, Max, can you? You need to take your minimum pension each year, 4%, starting at 4%, working its way up to, I think 17% above 95. You have to take your minimum pension. After that, if you need extra income, then you're better off taking a partial commutation to reduce that $1.6 million benefit. If you need another $50,000 or $100,000 to reduce your transfer balance account from 1.6 to 1.5. So you're better off taking a commutation if you need extra income above what you're taking as your minimum pension.
Right, but not as a substitute.
I'm not sure. There is one of the other changes that came out with these super changes. There had been a strategy going back that is now being knocked in the head for people who had transitional retirement pensions or other similar pensions who needed to get their minimum pension but were under 60 and ended up therefore paying tax at their marginal rates with the 15% rebate. You could do a partial commutation that was counted as a lump sum, and as long as they hadn't exceeded their total tax-free lump sum, which is now $195,000, they could get it out tax-free and it could count to their minimum pensions. That is stopping from 1 July. That's the main change that's happening from a tax point of view, that previously people were able to take their minimum pension out as a partial commutation, have it counted as pension but not pay tax on it even though they're under 60.
Good. Thank you.
Okay, thank you. We have a question from the middle.
You spoke, I heard different views earlier. I'm in a position where I have in excess of the 1.6 million. On the one hand, I heard that the way to shift money out of my existing super fund was to establish a totally new super fund, which was called accumulation mode. Then I heard someone say that was you transfer it into an accumulation account. What can I do, having been given two mechanisms?
You're talking about, there's two different strategies there. The first one is if you want to only have one self-managed super fund, continue forward one self-managed super fund, you've got more than 1.6 million, you haven't been using the segregation method. If you have 2 million in there and you want to transfer back $400,000 to accumulation, you can do that. You can have it in the one fund.
How do you do that?
Well, it'll be something that'll be done as part of your accounts for the FY17 year, so the June 30 year. The second part of that, which Max was talking about, and I have written a column about probably towards the end of last year, was if you want to keep your assets segregated and you're above that $1.6 million, then one way of potentially doing that is to open a second self-managed super fund and run one as your accumulation fund and one as your pension fund. Well, you were touching more on that, Max, if you want to add to that.
The interesting thing is, as far as the excess goes, unless you have all of the experience and are preparing your own accounts, and I don't know, there'd be many SMSF trustees in this room to be in that situation.
But there's at least one, because I spoke to one.
Okay. The worry about what has to happen from a point of view of you not being affected by the 1.6 million should be looked after by your administration service. So effectively what's going to be happening is within their systems they'll identify what you have at the 30th of June 2017. The excess will end up being transferred back to accumulation by purely documentation. All there will be is their documentation that you'll have ended up signing that effectively will have put into effect the fact that you've had your excess go into accumulation. That's step one. That's one that if you're going to be in excess, you would need to get a sanity test if you didn't do it because of the problems. Once you've done that, the next step then is to say, well, do I keep my accumulation and pension account in the one fund? Do I take my accumulation out and invest it personally because I don't have a lot of taxable income anyway? Or do I take out the accumulation and put it in with another SMSF or an industry fund? And that will be something that you can do a bit more in the fullness of time, rather than having to worry about it before 30th of June.
There are obviously going to be extra costs involved in running a self-managed super fund. So, as Max said, taking it out and that second pot that I was talking about, where you're dragging it out in your personal name, you've got your own tax-free threshold, it can make sense there. Shifting into a self-managed super fund with the extra cost, using an industry fund or you know, a wrap platform or something like that, where you can keep it in super and with reasonably low cost. So it's going to be very individual. There's no one solution you can say this is the best way of doing it. You've got to look at it for your personal.
In the short term,
circumstances.
do you identify the particular assets and shift them into pension mode, and other assets into accumulation mode?
That will be done at the 30th of June. In other words, because we've got a particular period in time being the 30th of June, once the accounts have been done, as a part of doing the accounts, once we've established any administrator or advisor worth their salt, we'll work out, okay, here's the excess, here's what we need to be doing, what assets do we have, what is pent-up capital gains, what isn't, what are those assets that are going to be best chance to go forward, obviously in consultation with the member and other investment specialists and stuff like this, and then as a part of the process, that will happen.
All right, we have another question just from the man in the light blue shirt, just on the right-hand side.
Thank you. A question for Max. Max, I'm confused. I thought I'd read...
Good, you're not alone.
I thought I'd read at various places over the last month or two that the ATO wasn't going to allow you to segregate and choose which assets to put in your accumulation account, which assets in the pension account, in order to be able to pick and choose. I thought it all had to be a proportional method.
No. The interesting thing is, one of the telling things that have come out from the tax office in recent times when this all started was any fund that is totally in pension phase is regarded by the tax office as having a segregated fund. Now, you don't need to go past that situation, because the only time you need to segregate or use proportional is when you have a fund with accumulation and pension. And don't forget, we're talking about a problem that's going to be only existing at the 30th of June this year. So therefore, the situation is, no, the only time when funds can't use segregation anymore is once they have more than 1.6 million. And that's after the 1st of July.
Okay, got a question in the very front row there.
I believe it was mentioned that for those people who are receiving a pension from a defined benefit scheme, that their annual pension will be multiplied by a factor of 16. How did they get to that factor? For example, is it the statistical average lifespan they're expecting?
No, it's simply 1.6. What they decided was roughly $100,000 was the equivalent of a $1.6 million pension limit. It wasn't perfect. It wasn't, it could have been 97,462. It could have been 80 something. It could have been 130 something. They basically decided $100,000 was the rough equivalent, given that this income will be generally increasing by CPI for until death, and 2/3 of it passes to your spouse. That was the number they came up with. So in order to do that, 16 times 100,000 is 1.6 million. 16 times any other number will be using up a portion of that.
I think it was a bit more scientific than Bruce. I actually heard Treasury set up a big dartboard and someone threw a dart. And that was
No, it wasn't somebody. It was a monkey, Max. It was a monkey. Yep.
Okay, so there's a possibility that it was purely random out of their
I don't think it was random.
intuition, gut feeling.
It was around that. $100,000 is
a reasonable amount.
5% of 1.6 million is 80,000. That's sort of where they were coming from. Completely tax-free income in drawing from a pension account of 1.6 million. For the defined benefits, it was 100,000 rounded up to the nearest lowest, something or other.
Okay, so just funny. They didn't release any information on how they came to that.
Apart from photos of the dartboard, that was it.
Okay, thank you, gentlemen.
Yeah, Ross Dixon. Sorry to come back to this segregation one again, but I'm reading from the Law Companion Guide 2016/D8. Certain MSFs and small APRA funds may not be segregated. A fund excluded from using the segregated method for the 2017-18 income year if it has less than 5 members. I currently have a segregated fund, but my reading of that is I have to desegregate and use the proportionate method as of the 1st of July 2017.
I'm not disagreeing with you, and what I said was you can use the segregation method up till the 30th June 2017. If you're over the 1.6, you cannot use it after that. So that's backing up what I said.
Thank you.
Getting away from all this accounting nonsense.
Excuse me, you're talking about my bread and butter?
Yes. Can somebody indicate, please, is there any advantage or benefit in having both an automatic reversionary pension nomination as well as a non-lapsing binding death benefit nomination?
That's yours, Bruce.
Yeah, look, I was talking to somebody else about this prior to as well. An accumulation amount can only be dealt with via a death benefit nomination. So if there is any part of your fund that is accumulation, then that needs to be dealt with a binding death benefit nomination. Reversionary pensions or automatic reversionary pensions can obviously only be left in regards to the assets that are automatic reversion, that are in pension phase. A few years ago, I think it was 2013 or thereabouts, there was a kerfuffle made and the ATO came out and basically said, we don't want there to be any possibility, if you want the pension to be continuing and not run into some tax complications that could come around there, we don't want there to be any doubt that the reversionary pension continued. So the term automatic reversionary pension came into stronger focus then. So if you want your spouse to continue to receive your pension on your death, you want to have an automatic reversionary pension in place in order to be able for that pension just to automatically roll over to your spouse at the moment of your death. The binding death benefit nomination is in regards to your accumulation assets. If you don't have an automatic reversionary pension, an ARP on your pension fund, and you have a binding death benefit nomination, becomes a death benefit, it's got to be paid out of the fund. So binding death benefits will make sure the money is paid out to who you want it to, but it won't allow a pension to continue. Does that answer the question?
And there's an interesting postscript to that, because if you have an automatically reversionary pension, and because of what Bruce said, when someone ends, and it doesn't have to be automatic, in superannuation law, a member can die and they don't have an automatic reversionary pension. The trustees of the fund can decide to pay the benefit to a dependent as a death benefit pension. So it doesn't have to be automatic. But if it's automatic, the problem is if that automatic reversionary pension sends the spouse over the 1.6, they will have to commute some of their existing pension in their own name to get down, whereas they cannot reduce the reversionary one because it's either paid out as a lump sum or the whole thing is converted to a pension. So if you have a couple where the wife might have or the husband might have a pension which is predominantly tax-free, you'd have to seriously consider whether you would have an auto-reversionary, because you could have a situation where an auto-reversionary pension has 20% tax-free, which automatically reverts to the spouse, and the spouse has a pension which has got 80% tax-free. They would have to take money away from that pension phase where it might be better to leave it there.
And it may be the case that you might have several pensions running and you want the auto-reversionary pension to be going to your spouse. There's a second one that was set up with NCCs that you do actually want to send off to children, or you want to go to somewhere else, and if you've got a binding death benefit nomination over that one, over that pension fund as well.
If there are both in being active, which takes precedence over the other?
I think it'd come down to the trustees.
The trustee allows both.
Yeah. So binding death benefit nominations are backed by law, and auto-reversionary. No, my understanding is they're a contract between the member and the trustee. They're not law binding, whereas binding death benefit nominations have the backup of law, is my understanding.
And the interesting analogy or the interesting complication in this is that If you're not in an SMSF, you've got to renew your binding death benefit nomination every 3 years. The tax office says you can have a non-lapsing binding death benefit nomination, but I don't know whether that's ever been tested yet. So it's
I've seen a lot with it, and I haven't seen a lot of it tested.
No.
I have a question myself, actually, which relates to Ron's slides. I'm allowed to ask a question?
No, mate, it's the Ron and Max show. Bruce and Max show.
How, just as a show of hands, having looked at Ron's slides, how well proportioned do you believe you are in terms of your asset allocation? Do you feel that your asset allocation is well balanced towards your investment objective, or do you feel that you're out of kilter? Just as a show of hands, who believes they're well balanced? Very good. And the rest?
I can say
mental stability.
I've met dozens of Eureka readers over the years who've come in to have a chat in my office, and there is a massive bias towards Australian shares and cash. I think that's got better in recent years, to be honest, but often going back a period of time, 80% of the funds, 90% of a lot of those funds would be Australian shares and cash. Not right or wrong, but there was a definite lack of balance. I think it has got better in recent years from what I've seen.
Six just said in their dumbbell slide.
I'm hoping there was a thing called the GFC that taught people a very valuable lesson.
Only for about a year.
All right, we'll go back to other questions now. That gentleman in the front row.
Thank you very much. I really enjoyed everything that was presented here today, but I've also got a really bad memory, so I'm going to forget most of what you presented on those slides.
We'll pass all these slides around, by the way, to everybody. So we'll email them automatically to you.
Thank you very much.
Oh, is that what you sorry. Saved you the question.
Just over there.
This is just a general comment, really. I don't know your name, sorry. Max. You had written up there on the board $2,500 to run an SMSF. I've been doing mine for the last 5 years through eSuper, and the whole process for my wife and I is only under $1,000. That's for both of us. And we can buy shares.
I'm talking about
options.
Yeah, I'm talking about eSuper.
$2.5 grand a year is.
eSuper, when it first started, had some fairly major restrictions on the sort of bank accounts and other things. There's no such thing as the free lunch. If you look at a true self-managed super fund which doesn't restrict you, and that's what I'm talking about, not a hybrid, which is like an eSuper as a hybrid SMSF. What I'm saying is the true self-managed super fund with no restrictions on it, taking into account audit fees, actuarial fees, accounting fees. I know that, but I'm just saying from that point of view, that's the area I'm looking at. I'm not talking about these major corporate type of things that end up in the past have had restrictions. To me, that when they started weren't a true self-managed super fund. They were called them, but you had to use this bank account, you had to use this broker. Now,
you can use
there's always something you're going to pay somewhere, but that's where we'll agree to disagree, I think.
Yep. Thank you.
Right, there's a gentleman just up on the left-hand side.
Thank you. My question is to Max. Can I just get confirmation that my understanding of something you said was correct? And that is that you will have the option to open a second SMSF after July 1. And if that's so, when is the horizon?
No, there is no restriction on how many SMS you've got and when you open them. There's been no change to those rules. The biggest thing that will need to be done is a very careful analysis of what will the benefit be of having the investments outside of the account that's got the accumulation pension, and that's going to have the accumulation. In Bruce's example, it's going to be a no-brainer with someone with 35 million sitting in a self-managed super fund that they will end up with a 3.2 million pension self-managed super fund and the rest in an accumulation one, because it'd just kill any tax effectiveness of the assets in that pension fund. So it's something that can only be done after looking at a case by case and working out, okay, what's the benefit going to be of setting up a self-managed super fund, and whether it through be eSuper or something like this. And the other big thing I didn't touch on is the $2,500 is not just doing the accounts. in the area I operate on, it's also offering advice and feedback and strategy and all the rest of it. So there's, you know, a very big difference. So what you'd have to work out then is what is the cost of the second SMSF going to be? What's the benefit going to be? And if you're talking about 2,000 to 2,500 compared to, you know, some of the better industry funds out there where if you're just going to have an accumulation, you can even have direct shares, you can have lots of different things. With an accumulation account that's going to cost you $80 a year, you'd have to end up getting a great deal of a benefit from that second SMSF. But it's a case-by-case basis, working out the cost benefit.
And about a month ago, to be put a little disclaimer on what Max and I have been talking about in this area, the ATO did come out and say, we're going to watch this space and we're going to watch what people do if we do notice that they're opening second self-managed super funds. We don't want them doing it just to avoid tax. So just a little note, the ATO will be watching this space. We don't know exactly what that means, but they're going to be taking an interest in it.
James, there's a man about halfway up on the left-hand side, then I'll come down to you.
Thank you very much. I have a question going back to the investment strategy. I noticed that there was a preference for international infrastructure. Australian infrastructure was silent. Is there any reason for the difference? Because interest rates will go up everywhere, not just in one place.
It's a global infrastructure. It's IFRA. So it's just one that our analysts, chefs like. We've got to be sort of like quite careful in how many securities we have in each portfolio, again from a cost point of view. So we think that one gives us the best exposure across the globe. It's called IFRA. It's an ETF on the Australian Stock Exchange.
Lady just in the second row.
I'm not quite sure whether this question is going to be for Max or for Bruce. It's just about the trust deed. I have got a trust deed which is quite old, 2007. Is it compulsory that we need to have it updated? I mean, who would normally be looking at it unless you have a kind of dispute, I guess?
There's no compulsion to get a trust deed updated. It's something that you need to look at occasionally to see if your super fund your trust deed will allow you to do what it is that you need to do. So there's been a lot of law changes since 2007, some of which, 2007 is a very good year. This might not apply to you, but 2000 is not a bad year because prior to 2007, you weren't allowed to gear in a super fund except for, Telstra shares, instalment warrants, blah, 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 but you couldn't gear into property and the other assets. So a lot of trust deeds prior 2007, early 2007 prior, didn't allow gearing. So that's one of the things that you do in regards to, I think, automatic reversionary pensions. There's been some rule changes in regards to those. There are other areas where the law has changed and the trust deeds from 2007, 2003, I still see some from the 80s and 90s that are just outdated, and for often $400, you get it up to speed, and you know that if you were to get an audit from the ATO comes in and has a look at your fund and what you're doing and say, hang on a second, your trustee says you can't do this, and you don't realise because it's the law, you're allowed to do this, but the problem is your trustee doesn't allow you to do it. For $400 or thereabouts often to get a trust deed updated, you'll get one that will allow gearing, that will allow everything that a modern super fund can do. So you don't have to get it updated. There's no law about that. But it's good practice probably to do it every 5 years or so, I would think, certainly to look at it. Yeah.
I don't want to have a brawl with my colleague here on that one, but it's something that I wrote about a while ago, and it's something, I'm in the SMSF Professionals Association, and they have a very good chat line where you can put up something and people will get back to you. And I put up something, why can't we end up basically having a trust deed which is very cut down, that basically covers off on most of the things, and this trust deed is going to be able to, or effectively all of the things that are allowed within the legislation will be allowed with the trust deed. And also I said, asking, is there really a need for trust deeds to be updated? And this came about by a rather large superannuation SMSF service owned by one of the big banks coming out and it was going through my firm at the present, and I disagreed with my partners who are no longer my partners, but that's another story, is that why are we writing to all of our members to say they've got to update their deeds, $300? And they said, oh, this has come out and we need to, and I went back to the people and they said, oh, yes, because there's been a change in I think, what was it? It was to do with the authorities that you can have when someone can't look after themselves. Enduring powers of attorneys and things like this. And I thought, well, if a deed's silent on something, surely it can't be, therefore held to not be compliant. And I even went back to the people who'd put this out, and I spoke to some of them, and they said, oh, yes, no, if a deed's silent, you can't do it. You have to be very careful. The self-managed super fund industry has become very, very large. And unfortunately, a lot of the providers out there are owned by the big banks. And if there's one thing that the big banks are good at, is making sure you pay when you don't necessarily have to. And there are a lot of people that end up requiring their trust deeds to be updated annually or whatever. The important thing is at some point, especially with the changes that have happened, for the sake of what we're talking about, have the deed looked at if it hasn't been updated for a while, get a sign off, and then make sure that you're going to a provider that effectively says, right, this deed, once we've made these changes and with the wording, we can pretty much, unless something cataclysmic happens, it will end up being able to be complying from now on. But just be careful if people say you've got to update it on a yearly basis.